Ever wondered how the Wall Street wizards always seem to be one step ahead? Well, let's delve into the world of investing with the book One Up on Wall Street by Peter Lynch. This remarkable book is more than just a guide. It's a treasure trove of knowledge that offers insights into the world of investing like no other. Peter Lynch, the author, isn't just any financial guru. He's a man who led the Magellan Fund at Fidelity Investments, generating an average annual return of 29%, making it the best performing mutual fund in the world under his leadership. His unique approach and strategic insights have turned many an amateur investor into savvy market players. The book, One Up on Wall Street, is an amalgamation of Lynch's wisdom, providing practical advice and strategies that can help you understand the market better and make informed investment decisions. But what if you too could be one step ahead of Wall Street? Stay tuned as we delve deeper into Lynch's investing wisdom. Are you aware of what you own in your portfolio? This question, seemingly simple, is one that Peter Lynch, in the first chapter of his book, One Up on Wall Street, urges every investor to ponder deeply. Lynch emphasizes that it's not just about having a portfolio laden with stocks from the biggest and brightest companies. No, it's about understanding these companies, their ethos, their operations, their financial health, and their potential for growth. To put it succinctly, you need to know the business that your business is in. Now, you may ask, why is this so crucial? Let's delve into that a bit. Imagine you own shares in a company that manufactures drones. You bought these shares because drones are trendy, and everyone seems to be investing in them. But do you know how these drones are made? What technology they use, who their customers are, or what regulations they need to adhere to? If the answer is no, you're essentially gambling, not investing. Lynch provides numerous examples in his Book of Investors who have made common, yet costly mistakes by not understanding their investments. One instance he shares is of an investor who put his money into a tech firm, dazzled by its cutting-edge products. However, he overlooked the fact that the company was hemorrhaging cash and was on the brink of bankruptcy. When the company did eventually collapse, the investor was left high and dry, his investment lost. Contrast this with another investor who invested in a mundane, unglamorous company that made cardboard boxes. This investor took the time to understand the company's business model, its steady cash flow, and the constant demand for its product. Over time, this investment yielded substantial returns. So, the crux of the matter is this. Investing without understanding is akin to sailing without a compass. You're at the mercy of the market's winds, with no real control over your investment destiny. So, knowing what you own is the first step to staying one up on Wall Street. Do you know the odds of hitting a long shot? Peter Lynch, in his enlightening book One Up on Wall Street, shares his insights on this very concept. Lynch is no stranger to high-risk, high-reward investments, often referred to as long shots. These are the stocks that have the potential to skyrocket, but they also carry significant risk. It's like walking a tightrope, and the fall can be steep if you lose your balance. He emphasizes the importance of risk management while dealing with these volatile investments. It's not about avoiding risks, but rather about understanding and managing them. Lynch advises investors to be aware of the risks involved and take calculated decisions. He encourages us to ask ourselves, can I afford to lose the money I'm about to invest? If the answer is no, then it's a gamble not worth taking. Lynch also stresses the need for diversification. Don't put all your eggs in one basket, he cautions. Spreading investments across a variety of sectors can help mitigate potential losses, providing a safety net of sorts. It's about creating a balanced portfolio, where the success of one investment can offset the failure of another. He reminds us that investing is not about chasing the next big thing, but about making wise, informed decisions. It's about understanding the market, studying the trends, and making strategic moves. Remember, the stock market is not a casino. Don't bet all your money on long shots. Do you want your investments to grow rapidly? Let's delve into the third chapter of Peter Lynch's One Up on Wall Street. Here, Lynch illuminates the characteristics of fast-growing companies and how to spot them. These are the companies that are expanding at an impressive rate, often 20 to 25% a year. They're the high flyers, the shooting stars, the ones that capture the imagination of investors. But what makes a fast grower? According to Lynch, It's not just about the numbers, it's about the story behind the company. It's about innovative products or services, a robust and scalable business model, and a strong management team. A fast grower is a company that is not only growing its revenue and profits quickly, but is also expanding its market share and solidifying its position in the industry. Fast growers can be found in all sectors, from technology to healthcare, from consumer goods to services. They often start as small under-the-radar companies, but their rapid growth soon attracts attention, and when they do, their stock prices can skyrocket, providing significant returns for investors who spotted them early. However, investing in fast growers isn't without risks. These companies are often in highly competitive markets and are vulnerable to changes in technology, consumer preferences, and economic conditions. Their fast growth can also lead to high expectations, and a failure to meet these expectations can result in sharp declines in their stock prices. Yet the rewards can be substantial. Imagine investing in a small tech startup that becomes the next big thing, or a healthcare company that develops a breakthrough drug. The potential returns can be astronomical, but these opportunities don't come without diligent research, careful analysis, and a willingness to take on risk. So, how do you spot a fast grower? Look for companies that are growing faster than the industry average, that are capturing market share, and that have a unique product or service. Look for companies with strong management teams who are invested in the company's success. And always do your homework. Fast growers can be a goldmine, but only if you know what to look for. Scene script. Are you looking for a safe and steady investment? In the riveting world of Peter Lynch's One Up on Wall Street, he introduces us to a concept of stalwarts. Stalwarts are those large, well-established companies that have stood the test of time and weathered many a storm. They might not promise the exhilarating growth of a small, fast-growing company, but they offer something equally important: stability and predictability. Lynch emphasizes that stalwarts have a crucial place in any investment portfolio. Their performance might not set your heart racing, but their robustness can provide a comforting buffer against financial turbulence. They are the tortoises in the race, plodding along steadily, often delivering consistent returns year after year. But like everything in life and investing, stalwarts come with their own set of challenges. One key drawback is that their size can often be a hindrance to rapid growth. They are like large ships that take a while to change course. This means they might not be the best choice if you're looking for a quick return on your investment. Yet, the beauty of stalwarts lies in their resilience. They are typically less vulnerable to market volatility and have the resources to survive downturns. They are the ones who have navigated the choppy waters of market cycles and emerged stronger for it. Stalwarts may not be as exciting as fast growers, but they can be a solid foundation for your portfolio. So if you're seeking a reliable and steady component to balance your investment portfolio, stalwarts might just be the answer. So how can you stay one up on Wall Street? Let's take a moment to recap the key insights from each chapter of Peter Lynch's enlightening book, One Up on Wall Street. It all begins with understanding what you own. Whenever you invest in a company, remember that you're becoming part owner. It's important to familiarize yourself with the business model, industry, and competitive landscape. By doing so, you're not just buying a stock, you're buying a piece of a business. Then we moved on to the long shots. Lynch advises us to avoid these altogether. They're the equivalent of betting on a horse with long odds at the racetrack. Sure, the payoff could be huge, but the chances of success are slim. It's better to focus on businesses with proven track records and sustainable growth. Next, we delved into the world of fast growers. These are the companies that are expanding at an impressive rate. They are the ones that could potentially bring you a significant return on your investment. But remember, with great reward comes great risk. Always keep a close eye on these fast-moving companies and don't hesitate to pull out if things start heading south. And finally, we discussed the stalwarts. These are the established companies that have consistently performed well over the years. They might not provide the thrill of a fast grower, but they offer stability and steady growth. Investing in these stalwarts is akin to planting a tree. It might grow slowly, but it will eventually provide shade and fruit. Each of these strategies carries its own weight, and it's up to you to decide which one fits your investment style and risk tolerance. By understanding what you own, avoiding long shots, finding fast growers, and investing in stalwarts, you're not just investing. You're strategizing, planning, and making informed decisions. With these strategies, you too can be one step ahead of Wall Street. Invest wisely and remember, knowledge is power.